them there. So welcome and to our 2019 annual investment briefing. We thank you very much for coming and we thank you for your support. My name's Paul Harding Davis. I'm the CEO of Premium China Funds Management. I've been on board for a couple of years now, so this is my second annual investment briefing. I remember many of you from last year. Okay, normally I wouldn't take all of your time with a disclaimer, but it is getting a newer world, so I will spend 5 seconds on it. Obviously, we believe everything in this presentation is accurate as at the time of producing the material, and clearly you're all professionals, and so we're not at all giving you any kind of personal or general advice here. It's information and factual briefing. This is the agenda we'll follow. I'll do a brief introduction, make a couple of points. There'll be a corporate update on value partners from our colleague in Hong Kong, Frank Tsui, who's here, and running around the country and being worked very hard by Jonathan and Clayton in New Zealand. Frank will take us through Asian equities, market review and outlook, investment theme, portfolio updates, and there's other reference material he can turn to. And then we'll show a brief video, and Jonathan will give us an update on Asian fixed income and the Premium Asia Income Fund. And we'll have a Q&A at the end. We normally get close to the end in terms of the presentation, and then if you need to go, but Jonathan and Frank will be able to hang around for 15 or 20 minutes to handle questions along the way. So in my introduction, I'm just going to touch on the Premium Asia Fund briefly, excuse me, and make a few comments about China from the perspective of myself, a curious pragmatist. I think you should all know, I hope you all got the communication, that from the 1st of July 2019, we reduced the fees on the Premium Asia Fund. That's the Asia ex-Japan Fund. We did two things. We removed the performance fee, and we've lowered the management fee to 1.33%. That's slightly lower than the biggest player in this space, and I think hopefully removes some potential impediments, particularly for research houses, and the PDS is obviously live in the market. Can I just check, has everybody seen the communication on that? Anybody not seen it? Okay, great. The performance on that fund is something we continue to be very proud of. You can see here the performance compared to a basket of all the peers in this space. That would be Aberdeen, T. Rowe, Platinum, etc. And this is since inception in December 2009. The green line is the Premium Asia Fund, and the blue line is the average of the peers. So it's been an outstanding performance, and you'll get a little more detail and breakdown on that later. The chairman and founder of Value Partners is, as you know, is Chairman Chia Cheng Hei, and I apologize to anybody here who knows how it should be pronounced. I didn't quite get that right, but when I was in Hong Kong recently, they gave me his biography, and I've been reading through it, and I found this to be a very interesting quote in it about value. And interestingly, in the book, he talks about value, not just about value investing, but about living a value, taking value principles into your life. But the core definition of value investing has never changed, but we must adapt. And the best adaptations they've made is in the difference between Asian companies and Western companies, that the human factor is even more critical in an Asian company. The Western companies are a little more institutionalized, and the impact of individuals is not quite as great. But in Asian securities, though, it's virtually an investment in the management of the firm, and that particularly applies to the chairman and the important role of the chairman in those organizations. And that's just part of what we do in terms of, as we describe it, walking the extra mile to understand companies better from a bottom-up point of view. So I did a little bit of work and research, and those of you who were here last year may remember I put up a photo of the Great Wall. It happened to be the part of the Great Wall that I'd climbed a couple of months before. I think physically the hardest thing I've ever done pretty much in my life. And this is a different photo, but I'll find another one for next year. Deloitte Business Outlook has observed that China has propped up Australia's national income amid a global slowdown. And I'll mention later that, interestingly, because despite the trade war, we've actually had a little bit of a free kick in because of iron ore prices and their shift and China's shift of their purchase of iron ore to more Australian iron ore. So we've actually had a slight benefit from the trade war. But I want to talk about China and its history, and it's a long and innovative history. If you look over here, that's 2205 BC, or BCE now, before the Common Era. And that's the first of the dynasties, the Xia dynasty. As we work our way through the years, you have one of the, this is obviously a well-known one, the Qin dynasty. The first emperor of China, the Great Wall starts, the terracotta warriors are built. The six dynasties, Buddhism is introduced. We get to the Tang dynasty here, first use of woodblock printing for books. That was a very early form of printing. 960 to 1279 CE. The Song dynasty, I think everybody knows gunpowder was invented in China, but I didn't know the magnetic compass was invented. The Yuan dynasty, Kublai Khan actually conquers China and decides he'll create his own dynasty and named it the Yuan dynasty. Ming dynasty, Beijing's the capital, the Portuguese arrive. Qing dynasty, and the Republican era, and China, of course, fought with the Allies in World War I and World War II. And now the modern era, the rise of the middle class. And we'll touch on that a little bit during the, as one of the themes during our presentation. This is Jeffrey Sachs. I'm sure everybody here has remembers Jeffrey Sachs from Columbia University. And he talks about China, and you've obviously, if you've been watching the news, there's a fair bit of talk about the fact that China is the second largest economy in the world. But in terms of purchasing power parity, it could be argued that it's the largest economy in the world. And he says China is not an enemy; it's a nation trying to raise its living standards through education, international trade, and infrastructure. In short, it's doing what any country should do in its circumstances, having coming from that poor background. And it's been an extraordinary achievement, the hundreds of millions of people brought out of poverty into the middle class. And China is not going to be like Russia and fade away. This is some research from, you can see the source down the bottom there, but what I found this fascinating. This is Russia and the USSR, and you can see how they're adjusted to purchasing power parity. They were unable to grow their economy. And here you have Reagan bankrupting the Soviet Union and the collapse of the Soviet Union, whereas the Chinese economy has continued to be well run and a strong rise, and Russia and the Soviet Union basically are only back to where they were. We get to the really exciting developments. China is reaching high income status, or as Morgan Stanley states, that China will break out of the middle income trap and join the rarefied ranks of high income society, in their view, by 2027, a defining moment, not just in China's economic history, but in Asia and in the rest of the world. And you can see the blue is the base case, and that's the bull and the bear. And economic freedom is making steady progress. This is obviously from a low starting point, but you can see how far along China's come in terms of catching up in economic freedom. Progress is still growing steadily, but slowing down, obviously, as it's no longer off a low base. But this is where I want to finish, this long-term theme that is so powerful for China, for the world, for Asia, and for Australia, is that private consumption is going to keep on rising. This is, again, from Morgan Stanley, and you can see the base case, the bull and the bear case, for private consumption rising to somewhere between 7.5 and 14 trillion. This is one of the really powerful themes in our portfolio and one of the powerful themes in the world economy. And of course, it's been positive for Australia too. But that's enough for me. You didn't really come all the way here to get an introduction or an overview. In part, you came here for our next speaker, who's Frank Tsui, Senior Fund Manager from Value Partners from Hong Kong, and absolutely delighted to have Frank here again. And if I could ask you to welcome Frank to the stage for the next part of our update.
Thank you, everyone, for sparing your time with us. And thank you for your continued support if you have invested into our funds. And for those who has yet to invest into our funds, hopefully you get some good takeaways from my sections and also from Jonathan's sections today. Just quickly, I'll probably spend 2 minutes just to talk about investment philosophy. We have started our shop back in 1993, so we have value bottom-up stock picker. With that said, what we're trying to do is every single investment in our portfolio has its own proprietary model. We try to calculate and forecast the fair value or the intrinsic value of the company, and we look at the share price on where we at today, or how much discount it is trading away from the fair value. And our core investment philosophy is to identify some key drivers that will be driving this discount valuation to the fair value. And this is how what we call valuation, value opportunities. We're a bottom-up stock picker, and I think we have one of the, I would say, largest team in the region, just to look at Asia ex-Japan market with a focus on Greater China equities. And that's why we have a highlight here that we do over 6,000 company visits annually. So averaging about 10 company visits per analyst per month. Some people, when they say 6,000 is a lot of, is a big number. So when it comes down to the number of people we have in the team, we're talking about 10 company visits per month per analyst. So I'm just going to share about what I think about the market in the current market situations, and then it will be followed by what we have done and what we have done right and what we have done wrong in the market current market situations. This is the slide that I've been using for the last 9 months' time. Versus last year, it looks pretty similar despite this discounted valuations. I think we have seen these risks is actually getting worse versus 12 months ago. Now we are actually seeing a global synchronized economic slowdown. So I think everyone sitting here are definitely investment professional, which I don't have to further explain. And also we are seeing some escalated trade tension, which I will spend a little bit more time to share what I think about the current situation is. And then we have seen a little bit change in the global central bank policy stance versus 12 months ago. Again, the global synchronized economy slowdown is actually going with a global synchronized new easing cycle. So last year we have seen an interest rate cut expectations in the market in the US, and now we're actually seeing 2 interest rate cuts this year, and we'll be expecting further cut from here. And then I think there has been quite a structural change in terms of the policy easing by the Chinese government, which I will also spend a bit more time later. And of course, the discounted valuation. Let's jump into the Sino-trade issues. This is the table could be a little bit confusing, but I think it's kind of like very straightforward as well, in the sense that we have gone through 4 batches of tariff hike that was enforced by the U.S. government. Initially, this was about 17 months ago. That was in April last year when we had the first batch, 34 billion China imported goods with 25% tariff. I would have to say, when it first came out, from 0 tariff to 25% tariff of this 34 billion China imported goods, it was shocking to the market. It was very negative because market did not expect it. So what happened to the market reaction is we have seen 3 consecutive months of market corrections. That was from April last year all the way to July. But I think investor, if you probably have seen the headline news, how did happen, or the development of this is we have gone through some back and forth negotiations. It's just like two nations are going into a ring and then punch each other on the face. With the fact that the expectation on this has come like a roller coaster. When we had the first threat coming from Donald Trump, then China just revenge with certain amount of tariff on U.S. imported goods to China, and then suddenly they felt like, oh, maybe we should sit down and have a shake hand meeting, and then they met, and then it turns out quite well, and then everyone was expecting some positive result, resolution by late last year, and then all of a sudden Trump just said, oh, China didn't really promise anything, so that's why there's a heightened tensions on the trade talk. I mean, for equity investor, there are actually two things that I would like to highlight here. Is that on where we stand here right now, 300 billion China imported goods with 10 to 15% tariffs, we're actually not too far from a full-blown trade war. Full-blown trade war means total 540 billion China imported goods with 25% tariffs. We are already having 540 billion China imported goods with the first four batches at 25% and the latest with another bucket with only 10 to 15%. So the next step for Donald Trump to lift the tariff, it will be raising this 10% to 25%. So one or two steps away. I would probably say two takeaway from here is that I think from an equity investor perspective, I don't expect too much of a downside from here because it has gone through, everyone has gone through the last 17 months, and everyone is actually kind of adapted to the trade negotiation pattern that everyone is not, expecting any resolution in the near term. So this is first thing. So the downside risk, if ever, will be actually going into the full-blown trade war. I think that will be giving in a very insignificant downside risk from here. Why I'm saying that is there are actually two reasons behind that. On the 1st of August, when the latest proposal was announced, market only went down for 2 business days, 2 trading days. And then when China actually further lifted the tariffs on U.S. imported goods, market only went down in the morning section, and in the afternoon section, the market just kind of narrowed down the loss. So this is the first, kind of observations on market reactions on this. And secondly is something that I will show later about what the market is pricing in at this, valuation level. And the second key point about, this whole trade scenario analysis is different from last year when U.S. and China market or the economy is still okay, that they could, really go for some like very aggressive kind of responses. This year, both countries, if you look at the macro numbers, especially in August when China, released the data in August, everything was softening. Everything is actually looking, not so good. That means we are leaving, the government or the policy maker with very little room to really battle on this trade war issue. And that, with that said, that means I would expect both nations to de-escalate the trade tension and escalate the stimulus policy. This is from a rational point of view. And China actually has been doing this, and the Fed is actually doing this as well. I'm not sure about the U.S. president that if ever he will be raising this 25% to 30% or 40%, which could happen based on his unpredictable kind of like pattern. I think it's unlikely, but just let's see how it goes. But we are actually already seeing both nations has already stepped up on policy easing. I mentioned earlier, very different from last year. This is January 2019, and this is the U.S. rate hike expectation, in 2020 and 2019. Last year, we were actually still expecting interest rate hike, and all of a sudden, That's a drastic change at the beginning of the year that everyone, not everyone, but the consensus is actually looking at interest rate cut. So the US has done some policy easing, but at the same time, what China has done maybe is worth noting. On the easing policy side, I'm actually stating this is the fiscal policy, have room for expansion. If you look at what China has done in the last 18 months' time, I will probably say usually China will roll out policy easing in 3 stages. Last year, we were actually in the first stage. That's more on the monetary policy easing. We have already seen a few triple R cut. That's the required reserve ratio from the bank. That means it's releasing a reasonable amount of liquidity in the system, and that's why you have seen the interbank rate has gone down. That's another way to cut the interest rate in the market. But we are actually moving to the second stage, which is the fiscal policy. Why we're seeing this is the monetary policy was not that effective. By lowering the interest rate, using the triple R cut, releasing liquidity in the market, if you look at the end demand of loan, it was very weak. That means the end demand was weak, that nobody is actually willing to borrow money to deploy capex, or there's not many local enterprise, private enterprise or state-owned government. They're actually not really willing to borrow money to really roll out different investment projects. So the liquidity easing on the monetary level, it did not really go into the real economy. So that's why we have stage 2. This is where we're at right now. When we talk about fiscal policy, usually we talk about this fixed asset investment, the FAI in China. Why I'm saying this, we have room for expansion from a fiscal policy perspective is that if you look at the infrastructure fixed asset investment in the public sector FAI, which generally include the property investment, we have seen a tremendous drop in the FAI from 2017 to 2018, late 2018. And this is the period when China had gone through the deleveraging process. I'm not sure if everyone sitting here really keep close track on the policy easing cycle in China, but this is actually quite interesting that I think China, prior to where we're at today, the top agenda or the top priority for policymaker is to deleverage the economy. This is what they are trying to fix on the results from the last easing cycle. The last easing cycle means in 2009, when we had the global financial crisis, Chinese government actually had rolled out a 4 trillion RMB liquidity. They flooded into the system, and they were actually rolling out a lot of infrastructure projects. They rolled out a lot of property projects to stabilize growth. That was from the last cycle. And what's the consequence of that? We have seen a lot of overcapacity issues, such as you've seen like the ghost town in China. That's, we've seen a lot of residential buildings in tier 3 and tier 4 city, but nobody's living inside that. And secondly, it's about in the northeastern part of China, that's more related to the steel mills, like, the commodity related business, that they have seen overcapacity issue because China, from the last cycle, they were actually rolling out a lot of the infrastructure project. And infrastructure projects means it requires a lot of commodities like the metals, the irons. So the last cycle creates a lot of overcapacity and high debt level issues. So, it succeeds in the sense that they support and stabilize the growth after the global financial crisis. So leaving what President Xi has to do, when he came into office in 2012, he has already set a list of agenda, and deleveraging, fixing the high debt economy, fixing the overcapacity issue has always been in his priority. So when you have this background, it's not that difficult to understand this. When in 2017, that was the actual deleveraging happened, because in 2017, that was the time when the economy was good. we have, seen a very robust economic activities. The industrial profit was positive. Things are actually generally more, I would say, reasonably in line versus the last cycle. And also, when the decapacity happened, decapacity actually happened in from 2000, I'll probably say 13, 14, all the way to 2016. So that was when the property inventory level and the commodity inventory level back to a more normal level. Then the government rolled out that they should stop, growing the infrastructure project. So that's why you have seen a drastic drop in the FAI percentage number. And also, that's also a reasonable time to roll out the deleveraging because you want to tighten, you want to roll out a tightened policy, tight policy when the economy was good. So, and now we're actually back here that, the fixed asset investment is actually at, low single digit or mid single digit number. And the council meeting that was held last week already confirmed they will be rolling out infrastructure projects to stabilize growth. So we are actually in stage 2 right now. So what you will be expecting in the near term from the China government policy is that the increasing local government bond issuance is going to happen because when the central government has set the agenda to roll out more infrastructure projects, that means the local government will receive that instruction if they need to finance all these projects. So the local government bond issuance will be a very kind of like the straightforward way to raise money to finance all these projects. But what I would like to highlight here is the upcoming bond issuance from the government. You will probably be looking at some not very exciting number. I mean, in terms of the scale of the bond issuance, because just bear in mind, Beijing is still having a very high priority not to over leverage the economy. They don't want to go back to 2009 when the economy was purely debt driven or credit driven. So it may surprise the market on the downside, but to us, it's actually a more, I'll probably say, healthy way to roll out all these projects. They are more targeted in specific areas when they are rolling out easing policy to stabilize growth. So China actually has stepped up on the easing policy cycle, so which is actually, I think that kind of makes sense. Because we are on the backdrop of global synchronized economic slowdown. So from an equity investor perspective, where should you be looking at? We're actually a value investor, as I mentioned at the very beginning. So I've listed out the PE ratio and the EPS growth rate. The PE ratio means like we will be looking at something cheap. So I've listed out different countries, including the developed market. US has always been on the right hand side. That means it's relatively expensive than the other countries that I've listed here. So on the very left hand side, we have China, Korea, and China Asia market. The perfect scenario is you are paying for very low premium or price to earning ratio while you can get decent number of EPS growth. So if it happens that things are cheap on the from the valuation side, and they appear at the same time on the very right hand side of this EPS growth, it's actually giving you a very risk return kind of profile. And if you're looking at here, China Asia and China market is still giving about double digit number for 2019. Heading to next year, we'll be actually looking at slightly lower number. For China offshore market, we'll be looking at maybe high single digit number, while the Asian market will be looking at low teens. So, I mean, it's up to, sometimes it's up to the choice of investor that, India market is actually the highest growth market, but at the same time, you will be actually paying premium because India appears to be the most expensive, relative to other countries here. So the next question that you guys may ask is, what about the valuation versus the historical number? So that's why I have this chart here. I'm taking out MSCI China 12 months forward PE. So MSCI China, the index was launched in early 2000, so I was able to, retrieve the data from 2005. The average since 2005 is about 11.6 times. So you would probably say, it's not that, really attractive because we're actually trading at 11.1 times. But just one thing I like to, bring out here is that MSCI China, there are actually two companies taking up 30% of the index weight. They are Tencent and Alibaba. And Tencent and Alibaba, first, they're actually trading above 30 times PE, and they were not in the MSCI index 10 years ago. So in order to have a like-to-like or apple-to-apple comparison, you could actually take out Tencent and ADRs. ADRs means, Alibaba, Baidu, JD.com, like all those e-commerce technology, internet-related names that are listed in the US. And then you'll be seeing, by extracting those names from the MSCI China index, actually they are trading at around 9 times PE, which is one standard deviation below the historical average number. So as a value investor, one standard deviation below the historical level is actually something very attractive if you're looking, from the historical data. So you would also probably argue, say, okay, so we're MSCI China is only like 15 years of history. Can you do something, with a longer history? Then I have this next chart here. So Hanxiang Index is, has a very long history. I'm able to, take out the number since 1973. And throughout this 46 years of history, we're actually now trading at one standard deviation below the historical mean. In the last 46 years, it only happened 8 times that the index valuations trading, at or below one standard deviation. That was back in early 70s when we have the stock market bubble, and then the Gulf War in early 80s, and then the June 12, 89 Tiananmen Square instance back in late in 1989. And we had the Asian financial crisis, global financial crisis, Europe debt crisis, and the hard landing fear in China back in 2015. So, I mean, I've extracted like different set of data just to kind of see if there's an evidence showing that whether the market is pricing in crisis-like level. Remember I mentioned about the trade war situations, that I'm not too skeptical or I'm not too worried about a significant downside risk from there, was simply because market are actually pricing in a crisis-like scenario as what we had today. So I think from an equity investor perspective, valuation does not necessarily means it could give you an indication that you go in today and you will be rewarded with certain percentage in the short term. But valuation do suggest that there will be, at this valuation level, you'll be looking at a high margin of safety on the downside and relatively higher probability in gaining positive return in 24 to 36 months time. So this is the on the valuation side that I like to highlight with all of you. There's actually similar situations in Korean market that this is the 12-month forward PE relative to Asia ex-Japan markets. Is actually, they are trading at discount, which is at the historical lowest level relative to other Asian countries. And if you're looking at the price to book, they are actually very close to the global financial crisis level. So again, something that is, looking quite attractive versus last year that we did not have, this kind of valuation level to look at. So with all this macro backdrop, what we have done is we have been avoiding the exporter that are very kind of like having a direct impact by the external trade war. So we are coming up with this core exposures in our portfolio. This is actually very interesting that I'll probably like to highlight a little bit. But before I go into technology, if you look at the consumption upgrade, healthcare, and China Asia's, these are something that is very domestically driven, and they are, I'll probably say, quite immune from the external trade tensions. Technology, not sure if anyone actually, probably, I think you've heard about, the Huawei instance. That's part of the negotiation, developments in the Sino trade war. If I remember correctly, in the first 6 months when the Sino trade war was announced, that was in April last year, in the first 6 months, China's response to the U.S. government, they're actually really taking on a wait-and-see kind of attitude to see how the development goes. But I think that was around late third quarter and the fourth quarter of last year. I think China has already made a very obvious but yet low-profile new directions on what they want to do to support their domestic economy growth. Remember I mentioned about they have the easing policy, but on the technology side, we have seen a very, I would say, tremendous picked up in the R&D investment. This is part of the new development on China. Remember China prior to, I'll probably say, prior to 2018, you have been, hearing about the government's agenda to do the Made in China 2025. Is that something that you guys have heard of, right? No. Okay. Okay. So China, this Made in China 2025 was a very high-profile propaganda prior to 2018 that China wanted to become, a technology or high-end value chain kind of like driven economy. The last, I'll probably say 2 or 3 decades, China has been a country that supply low cost labor. So China has been, on the low end, value chain that produce maybe textile, toy manufacturing. But up till now, they want to kind of transition the economy to a more high value chain manufacturer in China. In the world. But they actually, because of the high-profile propaganda, it was attacked by Donald Trump. The U.S. definitely, want to slow that down. So China, you hardly hear about this Made in China 2025 anymore after the trade war was, kind of like started last year. So in late 2018, we have seen some of the technology companies. I think also because of the Huawei instance, that China wanted to start, accelerating their investment in research and innovation on technology components. I'll just give you one quick figures. China is the biggest consumer in semiconductor, in the global. They consume over 50% of the semiconductor sales, in the global in 2018. Within that consumption of semiconductor, China was only able to manufacture or supply 14% of that. So 14% of that semiconductor is, being supplied by the domestic supplier. So the heavy reliance on, foreign countries such as Silicon Valley is actually a big problem when it comes to the trade issue. So late last year, China actually has sped up the development of this. And we're talking about the 5G. The 5G license was, was announced late last year. So a lot of the technology component-related supplier in Asia, ex-Japan, has, really picked up quite strongly. U.S. is actually, kind of like, I'll probably say, kind of like lacking because Huawei is the biggest 5G infrastructure builder in the world. And I think there's actually still difficult to find another key substitute that could, replace Huawei in that space. So we are actually seeing the speed up in this, and the Made in 2025 is still happening, but it's happening in a more low-profile manner, but also at the same time in an accelerating pace because of the Huawei instance. So when I talk about the 5G, this 5G, I'll probably say there's a broad usage of this new technology speed and it will open up a lot of revenues for growth. Having said that, autonomous driving, automatic factory, content, video, streaming, I would say, different. There are a lot of things. But what I'd like to highlight is if everyone sitting here has no idea about, how 5G will improve, our life in the next couple of years of time. I've listed out, I'm pretty sure everyone watch videos on your iPhone or on your smartphone. To download an 8 gigabytes video, if you're using 3G, it takes 70 minutes. In 4G network, it takes about 7 minutes. In 5G, it will only take less than 1 minute. That's 0.1 minutes. We're talking about 6 seconds to download an 8 gigabytes video. So that kind of speed, we're definitely moving to that era that we will be expecting a similar pattern of capex deployment as what we saw in the 4G development back in 2009, when we had a huge surge on Internet of Things capex deployment. So this is what I like to highlight among different subsectors that will benefit from 5G development. We'll be looking at the chips. I'm not actually particularly interested in the iPhone because the margin that you could get from 5G is relatively slim. Just look at Apple. I mean, the smartphone, every single year they price at similar level, but with a more advanced technology. So the margin that you'll be expecting from that, from a smartphone manufacturer, is relatively slim. So that's why you'll be expecting only around 2% CAGR growth from 2019 to 2023. That's the average annual growth. But all other sectors, such as memory chips, semiconductor chip, the cloud business, data center, you'll be all expecting a double-digit percentage growth. So we have two core positions to benefit from 5G development. I'm not going into every single one of them, but Samsung Electronics and TSMC, that's a company listed in Taiwan, is something that we are actually having in the portfolio. I think that's, we added in the second quarter of this year. We add more ways to it because of the 5G deployment. Samsung Electronics is actually, I'm pretty sure everyone knows Samsung Electronics. The revenue mainly comes from the memory price. The memory components. Memory components consist of NAND and DRAM, and they had gone through a very bad derating cycle because of the memory price drop throughout the most of the 2018. We're actually expecting memory price to come back because that's part of the 5G developments, that some internet smart devices require the memory chips, and we are also seeing the possible bottom out of memory prices by end of this year. So that will actually give Samsung Electronics a pretty strong recovery from the memory chip space. And also Samsung Electronics, despite the smartphone is not taking up a huge exposure of the revenue, but they are the key beneficiary of taking away Huawei's market shares in the smartphone space outside of China. So Samsung Electronics has gone through some derating cycle in the last 12 months' time, and share price right now is trading at around 12.2 times 2019 PE, which is actually quite attractive relative to other tech components company in the world. TSMC, just one sentence, is that they benefit from all sort of 5G components developments in the world because TSMC is a semiconductor foundry. That means the global component, big components, there's outsourcing the semiconductor chips manufacturing to TSMC. TSMC actually has the 7 nanometer technology to make it a very precise and high quality chip throughout the whole smart devices chain. And every single production line in TSMC, they are at very high quality because all the workers in every single manufacturing line, their workers have a PhD degree. So it's actually a very high quality company that will benefit from the 5G development. So this is what we have in the top 10 holdings for the Asia fund. And the next investment theme is what I'd like to share is the consumption upgrade. Um, Consumption upgrade, some people would just be asking, what's the definition of it? I think Paul has mentioned about the middle class, in China, but I think the middle class in whole Asia, ex-Japan, it's picking up strongly. That means you're seeing some wealth effect. People are earning, higher, income, and they are willing to spend more. So consumption upgrade is about the consumer willing to pay extra premium to get innovative or kind of like better lifestyle kind of consumption behavior. So I've listed out two things here. So this chart on the left, maybe ladies sitting in this room may actually have a better idea than me. That every single day, I'm not sure if every single lady here will put these three elements on the face, but sun, lotion, foundation, and powder. Usually I was told that it would take about 5 to 10 minutes to put this on every single day. This, what we call the 3-in-1 powder, that's made by Amore Pacific. Amore Pacific is the biggest cosmetic manufacturer in Korea. When they actually had this first, what we call the innovative product that came out to the market, it has received very positive feedback. And celebrity, they put it on their social, community platform, saying, this is something that I've been using and it has been tremendously good. So what happened is it has been driving Amore Pacific's margin expansion. When companies are able to deliver, this kind of innovation product that is able to charge at premium, it's actually looking exceptionally good. When the macro economy is slowed down, it gives pressure on the top line growth, but this company has the very strong execution and product pipeline that could help to protect that, to offset that top line slowdown and with the margin expansion. So actually, at the end of the day, we're seeing a relatively decent bottom line growth throughout, this stage of the cycle. So same thing happened, for the gentlemen, sitting in this room. I'm not sure if you have seen this. This is a closet that could actually dry clean and steam your clothes automatically. Anyone has bought this closet in your room? No, okay. This is a product by LG. I'm not trying to help them to promote this, but this is something that they have innovated last year. It's selling at around $1,300. Unfortunately, property in Hong Kong is very expensive, and we pay a lot of price for a very small home, and I cannot afford this. This is huge, considered huge for Hong Kong property size. But regardless of the sales of this innovation product, this closet actually gives LG about 60 to 65% gross margin just by selling this product. So remember I mentioned about when we're looking at value investment, we put a very high focus on identifying drivers that could drive the share price to the fair value. And I think this is something that we have been looking at on companies that can tackle the consumption upgrade trend in the whole Asia ex-Japan market. And this is particularly obvious in China. This is the Msci China year-to-date performance, which is only 6% positive. But if you're buying into domestic consumer staples and consumer discretionary, you could easily get over 30 to 40% return. And not only that, when we're actually talking about the survey on how people are willing to spend their money, improving myself experience and buying better products keep going up on a yearly basis. So consumption upgrade consists of a very broad range of consumer goods. One good example in our portfolio is this Nissin Foods. It's actually in our top holdings, top 10 holdings, and it has been one of the top contributor to our portfolio year to date. Nissin Foods, I'm not sure if anyone eats instant noodles. Its parent company is a Japanese company. So what they do is the instant noodles, like the cup noodles, you know, it's something what we call consumer staples, which is relatively less affected by, you know, the macro slowdown. But what they have done is they actually had a new business line saying by developing a what they call the premium instant noodles, which the basic cup noodles is a fried noodles, where the new premium product is baked noodles. So the promotion on that is they're trying to give consumer a sense that it's healthier. So it actually attracts quite a bit of sales in that premium product line when they first launch it. They are charging about 30% premium over the base, you know, cup noodles. And if you're looking at the latest earnings number, the operating profit has gone up 102% year on year. So again, this is something that we would like to highlight that, you know, some company with a very strong execution, you know, history or record, that will be something that when we are looking, you know, going out to meet these companies, when we know their product pipeline, this is something that we like in our portfolio. And not to mention that Nissin Foods is a non-benchmark company, and it's in our top 10 holdings. So this kind of highlight our character that because we have the resources to, you know, dig really deep into like different companies to research and discover some under-researched stocks, we got, you know, pay off by, you know, generating excess alpha in this what we call the non-benchmark company. So lastly is about the A-shares market. It's a very straightforward concept, but I think not many people has yet to realize this. The Asia, MSCI Asia inclusion, probably you've heard it, that, you know, it was announced in last year that, you know, different MSCI indices will be increasing the Asia market. That's the China onshore equity market in respective indices. So last year, we were actually seeing China A-shares exposure in the global GEM index going from 0 to 0.8%. And this year, it has speed up to 20% Asia inclusion. That means by end of this year, we'll be looking at 3.3% in China Asia's exposure and weight in the global GEM, MSCI GEM index. And with that said, we're actually seeing $70 billion US dollar passive flow going to this market. And we're talking about only the passive flow because, you know, they have to adjust their portfolio to reallocate the weight to Asia market. However, a lot of the active manager has already front run this you know, investment concept that some of the we have seen quite a significant net inflow into Asia market in late last year, as many investment managers are, you know, active managers are going into this market because of this. But what I would like to highlight, you know, in this investment theme is that in China, first of all, the MSCI Asia inclusion will have a structural change in the investor base in the Asia market. Over 80% of the Asia daily turnover is driven by retail investors. Retail investor in China is very different from retail investors, you know, offshore or, you know, the rest of the world. They are very irrational. They are not fundamental driven. They're purely news flow driven. When we talk about, you know, purely news flow driven means they are not interested in company that give about 10 to 15% per annum. They're looking for companies that could give them 40 to 50% in 3 months' time. It's actually a very different investor base in China, Asia. But with the help of the MSCI Asia inclusion, it's going to bring down this 80% number down. So what's the opportunities here? Is that we are seeing more, I would say, fundamental driven, institutional, more mature investor going into this space. And that will give some re-rating for some what we call the under-researched stocks in the space. I'll give you one example. China Asia consists of over 3,500 companies. The biggest sell-side broker only cover about 400 to 450 names in the space. Those sell-side brokers is like Citi or Bank of America, Merrill Lynch. So there's still massive number of companies that is undercover, under-owned, or under-researched. So that creates quite a bit of market inefficiency from an active portfolio manager point of view. Lately, we have been allocating our Asia exposures in what we call the second tier blue chips company because first of all, the flow that we have seen in Asia market from the last 12 months, they are mainly going into the biggest cap, the blue chips company, because a lot of the people, they're just, maybe it's their first time ever investment in Asian market. So things are, really logical that they would just go for the biggest cap or the blue chips company. But later, when we see this number bringing down, and when we see more fundamental driven manager or investor in the Asian market, we believe the second tier blue chips company, which has the same robust earning profile, quality management, that eventually they will be recognized and drive the re-rating of these companies going forward. And if you're just ever a question about whether you should go for ETF or active manager, I've listed out the CSI 300, which is the index, the most popular index reference versus the active fund performance in different periods. This is a 10-year performance, 9-year, 8 years performance. Every single period I listed here, active funds outperform the benchmark index. So it gives it kind of like helped me to support my view about the market inefficiency in Asia's market, that it's still having a lot of, I would say, bottom-up opportunities for us to select in this onshore Asia market. So before I just quickly go into the portfolio positioning, I would just like to, because this is the last slide of the market view, maybe just 3 quick points to summarize what I have probably briefly mentioned in the last, I think, 45 minutes of time. First is, I think global cycle, we actually have seen a new easing cycle. So with that said, I think equity may not perform at the beginning of the easing cycle because people are still worried about the recession risk or the softening economic data. So I'm not expecting equity market to do very, very well before end of this year. So this is first thing. Second thing is, I think China has actually made a very, I would say, good decision in terms of rolling out fiscal policy and also starting their own manufacturing on the technology side, because they're not really going head to head on this trade issue, but instead they're doing it, more silently, but helping to stabilize growth. And one good thing about why I'm saying I'm comfortable with what they are doing right now is they're not flooding the economy with very high credit numbers. So back in the old days, very high debt causing a lot of consequences. I think as of now they're doing some adequate kind of like policy scale or magnitude so far. So I'm actually quite okay with that. And lastly is the valuation. Valuation, we are actually, market is already pricing in crisis-like level. It does not mean, we cannot go further down because we're dealing with a world of, geopolitical risk, which is, unfortunately, I don't have a crystal ball, to predict what's going to happen. But from the valuation point of view, this is something that has proven in the past history that you will have more downside probability, higher upside probability than downside risk. So this is, the 3 takeaways on my macro slides. So one last section about, on our portfolio. Premium China Fund and Premium Asia Fund, we have been delivering a fairly, stable outperformance over the benchmark. So if you're looking at, what we are, how we are positioning right now, as mentioned earlier, we're pretty much in the consumer space. Communication services is basically Tencent. It takes up quite a bit of our exposures. And consumer staples. One thing that I'd like to highlight is we're actually, our portfolio is structured in the sense that we don't have direct exposure or impact from the external trade war because we don't have, exporter in our portfolio. And secondly is the recent Hong Kong market situation is more kind of damaging the Hong Kong companies that have their own business based in Hong Kong. So just bear in mind this 36% Hong Kong listed companies with I'll probably say 2/3 of it are Chinese companies with the revenue driven in China. So just don't get confused that Hong Kong exposures is are those companies that are affected by the latest developments on in Hong Kong. Yeah. So as I mentioned earlier, we have some what we call the non-benchmark or under research kind of names, and has attributed to our portfolio quite positively. Nissin Foods and Anta is actually two of them. We have Moutai, that's the Asia very big cap blue chips company in China, but we're actually looking to maybe trim it because the valuation is getting very rich. So for similar to Asia Premium Asia Fund, we have been delivering some of the very stable outperformance so far because we have been really allocating into consumer-related names, and information technology is the Samsung Electronics and TSMC that I mentioned earlier, together with a few other Taiwanese technology component supplier, which actually they get really decent orders because of the 5G infrastructure developments. So another key thing is Asia market. We have been positioning ourselves with about 7% exposure in our Premium Asia Fund, which is quite a high, heavy, overweight position relative to the benchmark. If ever benchmark is something that you would reference. So that's pretty much about my presentation. Hope you found this useful, and I will pass it on to Paul, and then I will come back up for more questions. Thank you very much.
Thank you.